So why is the Figma IPO shaping up to be a pump and dump? IPO price was at $30. IPO yesterday, the stock opened at 80, closed at around 120. After hours went to 150 and is currently around the 131, 140 area. 585 million shares fully diluted by $140 gives us approximately $82 billion in market cap. Should this company be worth 82 billion right now? Let's see. First of all, what is Figma? Well, I'm not a user of the company's tools, but they are collaborative tools for design and product development, from the idea stage to visualizing the UX UI, what the app will look like, to building it, to shipping it. Right now, they are making 91% gross margin. Not a lot of room to go up from there. Interesting statistic, 130% net dollar retention. It means that they are generating more revenue from their existing customer base. I assume by selling them more of their tools and or increasing prices. So you see 76% of customers use 2 or more products. So penetration is high enough, and 78% of Forbes 2000 already use Figma. Okay, noting this. Now we see 95% of Fortune 500 already use Figma. That's very high. Penetration is very high. Obviously, not more room to grow in penetration, but more room to grow in revenue and selling more tools. 13 million monthly active users. Sounds like a lot. Let's look at their financials. This is from the S1 registration statement. So revenue for 2023, $500 million. Revenue for 24, 750 million, 50% increase. But we see first quarter 25, almost $250 million. So assuming continued growth, you expect them to hit 1.2, maybe 1.3 billion for the year. However, they made no money in 23 and no money in 24 either. Why is that? Let's see. In 24, almost 900 million in share-based compensation. All that has to be deducted from the income statement, but let's adjust for share-based compensation by looking at the cash flow. So 730 million loss, you add back almost $1 billion and some more adjustments here. Let's ignore this. So 211 million in free cash flow for the year 2024. If you adjust for SBC, still a loss. Okay, let's keep share-based compensation out of it right now, but make sure you know that's still a serious cost. So for a company that can double revenue, you can see how annual cohorts keep bringing more annualized recurring revenue by selling more tools at higher prices to their existing customers. And obviously, they're going to convert more free to paid subscribers. I would expect to see this company generate 2 billion in sales. But what's a normalized margin? 30%, 40%. So at 30%, 600 million free cash. At 40%, 800 million. What did we say it's selling for right now? What did we say it's selling for right now? 80 billion by 800 million. Free cash flow equals 100 times free cash, considering 2 billion in sales and 40% in free cash flow margin. So even at $2 billion of revenue at 40% free cash flow margin, which is kind of massive for a company still spending big money in sales and marketing, competing for talent, R&D, SGA costs. Let's assume a very, very hopeful 40% at 2 billion. The company can make 800 million free cash flow. And it's selling for 80 billion right now. So massively undervalued. And personally, I would never touch this.